Hello and welcome to Thank God It's Friday, Bloomberg Quint's weekly edition where we bring to you market experts' views. And joining us on this Friday, we have Hiren Ved, Director and CIO at Alchemy Capital. Hiren, thank you so much for joining us on this occasion. We were just discussing about how you've been tracking the Indian markets for the last good 25, 26 years. I just wanted to understand how have things changed over the past 2 decades in terms of corporate governance or investment opportunities. Was it easier to make money back then?
Yeah, I mean, when markets are imperfect, there is more opportunity to make money. Over time, access to information has improved substantially. You have a concept of quarterly results, you have conference calls, you have analyst meets. You didn't have any of those during the earlier days. And as I was just telling you, in the early days, you had to go to the stock exchange where they used to put half-yearly results on the notice board and take them down, and then probably come back and then analyze them in the office. To get access to companies, we had to go and attend the annual shareholders meetings of these companies, because that was the only time that you got face time with the management and you could ask the relevant questions, try and make friends so that you can reach out to them later. There was no concept of conference calls or things like that. So I think the speed of information and the access to quality information has gone up by leaps and bounds. Obviously, as the markets get more perfect and the number of players increases dramatically, it becomes tougher and tougher to make money. But I still feel that despite that, India is a great land of opportunity. There are 5,000 listed companies. Our economy is still evolving, and there is still, for a curious mind and a person who wants to work hard, there's still money to be made.
Okay, since you're talking about the economy and the prospects, I just wanted to understand which phase, according to you, is the Indian economy in? Are we still in the recovery phase? Are we at the trough, or are we already climbed that path towards economic recovery? Has the expansion phase already begun? And again, is there any scope for PE re-rating further from here on, like the kinds that we saw post February?
So I would say that we are in the early phases of a recovery. Clearly there are parts of the economy that have begun to show some growth. There are parts of the economy which are still lagging. We all know that private investment is still lagging substantially. There are areas in consumption that have done well, and the government spending is doing well. So I think if you look at the what drives growth, I think that amongst the drivers of growth, consumption and government capex is driving growth. Private capex and trade or exports is still very, very slow, right? I mean, India may still be taking market share in certain areas in exports, but on the whole, trade growth has been very, very slow. So I think it's like, out of the 4 engines, you're running on 2, and the other 2 have yet to fire off. So I think you're in an early stages of a recovery. And that's probably also reflected to some extent in the market valuations, because what happens is that when you are going from trough profitability, usually the PE of the market goes up first and the earnings follow. Earnings is always a lagging indicator. PE is a leading indicator.
Right.
Similarly, in 2008, when the market started to correct, and you would go and ask a company or a management, they would say, my business is doing fine, but I don't know why the stock price is falling. But the markets are very smart. In 2008, the PE contracted first, and the earnings fell later on. You only realized it in March 2009, when earnings actually degrew. when expectations were very high early in 2008 that earnings will keep growing at 20-25% plus. So I think we are in a reverse situation right now, where margins are at 15-year low. Capacity utilization in many sectors is very low. So you are not on your normalized profit growth. But at the same time, there are few things which have started to turn around. And obviously the easy liquidity that we're seeing around the world and the fact that cost of capital in India is falling means that we've got to lift off in PE first, and hopefully the earnings will follow.
Right. Okay, so I want to come to current affairs now, and I'm sure you're privy with the ongoing issues with respect to the Tata Group and its ouster of its chairman. And this is going to be in the realm of speculation because we do not know what's going to happen. But if the Shapoorji Group were to move out of the Tata Group with respect to shareholding, would you have any guesses as to what could happen? And secondly, if there is a correction right now, we have seen a little bit of correction in all the Tata Group stocks. Would you go in and buy some of these companies?
See, first of all, we have to understand that the Tata Group is a group which has been around for many years. Okay, so it's not the last 10-year, 20-year phenomenon, it's a last 100+ year phenomenon. When you have such deep-rooted history, a group will never crumble just because something happens. Now, obviously, the group has become fairly large and complex, and it is going through its usual metamorphosis, right? So, typically, groups that survive have to change. Sometimes that change leads to friction. It causes things to unsettle for a while, but then things will get back. If you ask me, will it dent the reputation of the Tatas as we see it? Probably a little bit of sheen, has worn off. I mean, people are a little surprised at the manner in which, things have been done. But having said that, I think that it's a large institution, and things will sort themselves out over a period of time. As to whether I would buy on a correction, I think, see, we have to realize that some of the things that have come out in the open are not necessarily new revelations. Okay, I think the markets were very smart. And if they believe that Tata Steel Europe was a bad decision, then the market discounted it in that manner. It's not something new. The fact that the overseas properties of Indian hotels are not making money or are ROCE dilutive, the markets are much smarter. They discount all of this much quicker. Obviously, from here on, I think what investors would want to see is that now that many of these issues and the debates are out in the open, how some of these capital allocation decisions that were taken in the past, probably you can always, in hindsight 2020, question some of the decisions, but it's not about history, it's about the future. And what the managements of each of these companies decide to do in order to improve the profitability of their businesses is, to my mind, more relevant from a future stock price perspective. I mean, these shocks can keep coming, and you will see a downdraft, and then obviously you will see things coming back to normalcy. But I think the longer term trajectory of the valuations of these companies will solely depend on the fundamentals and the future actions that managements take to grow these businesses profitably. So if you ask me, I would still say that they still have a stellar reputation, that despite what has happened, the investors are likely to give them a benefit of doubt and some more time.
In the same context, I just also wanted to ask you if you think there is a case for some sort of a reshuffling, even as far as the senior managements of some of these private banks are concerned. PSU banks, we've already seen that happening in some of the cases. So reshuffling for managements where there's been a big bad debt pile up, should managements really be made liable for some of this?
See, again, I think that what happens is that in India that the equity markets adjust to the new reality pretty quickly, right? So if a company is very highly indebted and it's not able to service its debt, obviously you'd see a massive drawdown on the equity value. So in the enterprise value, what remains is debt. Equity value becomes a very small part of the enterprise value. So the market in its own wisdom penalizes. But our structure was not amenable to fast change, as in banks could not easily take out a management and bring in a new management. And there was a flaw therefore in the laws and regulations governing change of management. I think with the passing of the bankruptcy law, I think it's a seminal regulation that has been passed in India. Obviously you still have to iron out and you have to see how it is implemented.
Right.
But I think that just like any other market, a developed market, companies should be free to be bankrupt. Lenders should be free to sell assets and recover their money, and if required, even change managements. Have we reached there in India? I think we are far from there. Have we taken the first few steps towards that? I think so. And I think that, today more than at any point in time in the past, I think there is, investors are looking at governance as a very, very important pivot around taking investment decisions.
Right.
So whether the law does it or not, the investors will penalize you if they believe that your governance structure is not right. And I think it's going to be increasingly difficult for some of these companies to go and raise future capital for growth.
Right.
So that's I think that is something that so the market mechanism is already taking care of a few things, but I think for sustainable growth and to attract foreign capital, we definitely need to have the ability to change managements if required, to sell assets if required more freely, and not have these judicial interventions all the time which take years and years. And I think some of the managements have taken advantage of the fact that they could block any of these things because of the way the regulations are today, and our judicial system is not geared to take quicker decisions.
I just wanted to understand, we've known that Bajaj Finance has been a multi-bagger for you. It's been one of the best performing stocks in your portfolio. Just wanted to understand what your stand on Bajaj Finance is. I know you're a long-term investor. You've been with the company for a long time. You rode that entire rally with them. But what have you done with your allocation? And second, which is your next bet as far as the NBFC space is concerned?
No, I think, obviously, we've had a very good experience being investors with Bajaj Finance. I think they were there at the right time, at the right place, with an excellent cutting-edge management team, and I think they have been able to exploit the opportunity to the full.
Okay.
I still believe that from a long-term perspective, there is a lot of growth ahead of them. All said and done, it's still a 50,000-60,000 crore balance sheet. Most of the large banks in India have much, 10 times the size of the balance sheet that Bajaj Finance has. So and the market is growing, right? Financial services in India is still fairly underpenetrated. So if you ask me, long-term growth is still there. Now, obviously, because of the stellar performance that they've shown over the last couple of years, the market has now rewarded them with a very high price to book ratio, a high PE ratio. It's hard to argue that there is any further upside as far as valuation is concerned. So I think as investors now, you'll probably get the earnings compounding. Right. So possibly if you bought this 3-4 years ago, you could have got a combination of earnings growth and multiple growth. You can't argue for a multiple growth from here onwards. I think will the multiples remain high? I think the multiples will remain high because of the sheer quality and the growth opportunity that is ahead of it. On the whole, I think I'm still bullish on NBFCs in general. I.e. because we are in this unique situation where the economy has to grow, and therefore financials is a great way to play the growth in the economy in several sectors, whether it is through corporate lending, whether it is through retail lending, whether it is through selling or distributing financial products. I think the biggest opportunity in financial services, the way I see it today, is at the bottom of the pyramid. The fact that this government has rolled out the UID program, the previous government and then carried forward by this government, and the whole DBT framework, I think they've laid the basic infrastructure on top of which many financial services will ride. What was supposed to be the mandate of the public sector, which is to go into the hinterland where the private sector is not going to go to every nook and corner and deliver banking services, to some extent they've been able to fulfill. To a large extent because of the structure of the way the PSU banks and their and the structure and the cost and the way the managements are built, they were not able to fully exploit that opportunity, right, which today is being done by some smarter private banks, more largely by the NBFCs, and even more important by the microfinance companies. So I think that's where I see a future opportunity for growth.
Right. Well, actually, coming to the consumption space as well, we are looking at numbers from the auto sector. Of course, we've had some earnings today as well, and the volumes have been mixed for the quarter. Not necessarily great, but we are seeing some amount of recovery. Based on the indications that you're looking in the auto sector, along with some of the other consumer durables, what trends are you picking up with respect to consumption, specifically in the discretionary space?
So as I said, I mean, discretionary consumption is a big driver for growth in India. But again, from what we've seen as a trend, it's been a winner takes all strategy. What I mean by that is that if you look at four-wheelers, for example, then I think that other car companies are not growing as well as Maruti is growing, and this is despite the fact that Maruti has got a capacity constraint in the current year. But that tells you that yes, there is demand, but it depends on, it's not a secular demand for everybody. So you will see differing or differential growth rates within autos, within consumer durables. If your product is good, if your pricing is good, if your distribution and reach is there, you have a better chance of attacking the consumer wallet than anybody else. We have to keep in mind that while consumption is growing in India and will continue to grow, but I think a big challenge that I see is that we have to be starting to create enough new jobs to get consumption growing. I think some of the consumption growth that we've seen in India is something which is being driven by consumer debt. Right. Okay. Now, right now it's not alarming because consumer debt in India is still much low, but we cannot take the eye off the ball, and we have to keep at the back of our mind that the more sustainable consumption is not just the consumption that you do by taking on more debt and EMI, but eventually by creating more jobs and income. And that is the big challenge that we have in front of this government. I think they do realize that. The problem is that 10-15 years ago, the whole tech industry created high paying jobs, and then these guys, both because of the handsome salaries they got and the ESOPs, created a real estate boom, created a consumption boom, created a two-wheeler boom in the country. You now need either manufacturing or high quality skilled service jobs to maintain this model, right? And we all know that the tech industry itself is going through a metamorphosis. So they are trying to grow productivity per employee than just the number of employees. So they're not hiring as many software engineers that they were doing 10 years ago. And therefore that's the challenge. So where you need to create high value jobs, and for that the investment cycle needs to kick in. The construction sector was lagging. It is one of the largest employers of unskilled people. So a lot of those things have to start to kick in if we have to keep consumption going. The good thing is that after two bad monsoons, we've got a very good monsoon this year. That's likely to give you a fillip to rural consumption this year. But what about the next year and the next year and the next year, right? So I think yes, consumption is a bright spot, and it is driving the economy right now. But we need to start creating jobs to make that sustainable.
Are you seeing any contrarian bets currently, say in underperforming sectors like industrials or even something like commodities, which has run up?
So I think the time to bet in commodities was early this year in Jan-Feb. Commodities have rallied, oil prices have rallied from $25-26 to almost $50+. So I think that the commodity prices were so battered down that we had to see a little bit of a rebound. We are seeing that. In some sectors, we are seeing that China is managing to manage oversupply to some extent, and therefore we've seen coking coal prices go up, iron ore prices go up. So we're seeing some rebound in commodity prices. Do I think it's a secular rebound? I don't think so. I think global growth is still very challenged. Trade is just, I speak to people in shipping, in international logistics, and they tell me that they've never seen such worse days as far as international trade is concerned. So I think that it's more of a supply being managed in the short run, which is leading to prices going up. It's not about demand growing at a very heavy clip. So I wouldn't, for example, bet on commodity companies. I'm just talking in general. There can always be exceptions to the rule, but generally speaking, I don't think this is the area where you can take a big bet and say, I think commodity prices will keep going up, though I could be wrong there. I think where the money is going to be made, according to me, on a contrarian basis, is really in some of the stressed sectors. As some of these things get resolved, maybe, very, very few, maybe some of the large PSU banks could be a contrarian play, or some infrastructure companies which are able to deleverage their balance sheet, and we know that there is business happening in areas like roads and so on and so forth. So there could be some pockets of good EPC companies that might do well. So there will be pockets in manufacturing, in infrastructure, where in some of these beaten down areas where you see a turnaround, where the companies have been able to resolve some of the balance sheet issues, where money could be made.
Okay.
So we have a fairly young audience, and for their sakes, we often have these questions for our guests. My question for you in this case is, what is your stock selection criteria, and what is the investment style that you identify with the most?
So typically at Alchemy we are growth investors. Okay, so So I think that what works in India, according to me, is growth investing. I think markets are willing to give a good valuation to sustainable growth, to high quality growth, um, uh, because there is under penetration in many areas in India. In the strictest sense, does value investing make sense in India? Yes, but if you ask me where the biggest money has been made in India, it's all been in growth. Right? So wherever companies have been able to grow, whether it is HDFC Bank over the last so many years, whether it is ITC, whether it is the generic pharma industry, whether it is the private banks, all of the big money in absolute terms, the big market caps have been made because these companies have compounded at 20, 25, 30% a year for many, many years together. So I think growth, we are growth investors at Alchemy. What do we look for? I think our framework is that we look for a large external opportunity which is expanding. We look at companies that we believe have the ability to exploit that opportunity. So we look for a competitive advantage, that if the opportunity is large, everybody would want to take a shot at it.
Right.
But why is that company A can do it better than B? You need to have a competitive advantage over your competitor to be able to exploit that large opportunity.
Right.
So you have to identify, and that depends and differs from industry to industry. In a consumer business, it could be brand, it could be distribution. In a manufacturing business like cement, it could be cost leadership, it could be your logistics capabilities, right? So every industry, you have to look at what is your competitive advantage. Third, scalability. I need a company, if whether the same company can have the same profitability or better profitability and metrics when he has a 500 crore turnover. Can it go to 5,000 crores? Can it go to 50,000 crores?
Right.
Yeah.
Scalability is important, right? You can be excited about a niche business, but if it can't grow, it's not going to create absolute market cap and therefore wealth for you.
Right.
Then you need a good management team, governance, all these are equally important. And last but not the least, all of this at a reasonable valuation.
Right.
So I think our framework is large external opportunity, a competitive advantage to exploit that opportunity, scalability and operating leverage in the business, good quality management, and all of these four at a reasonable price. If we find an opportunity that falls into this broad criteria, then that becomes for us a potent universe for us to invest in.
How often do you come across an investment opportunity or potential which fulfills all these criteria, the tough criteria?
Yeah, I mean it is, but as I said, if you look at domestic consumption stories, India has a large opportunity in so many categories, right? And you have to look at companies which have that competitive advantage to exploit that opportunity. Take example of Maruti, for example. There's so much opportunity in the four-wheeler space in India because the cars, we have one of the lowest cars per 1,000 people.
Yeah.
But if the opportunity is so big, and every other car company has come into India. There's Ford, there's the Americans, there's the Japanese, there's the Europeans.
Yeah.
But Maruti still has a number one position. I remember when there was a lot of competition and people said, oh, you should sell your Maruti because he's going to lose market share very quickly because there's so much of competition coming. But why is it that Maruti actually, after a slight fall in market share, it's actually regained market share? Is because of its competitive advantage. The other guys came, but they don't have the volumes. They don't have the dealership and distribution network, and therefore if they don't have, and Maruti had a natural advantage of being in India for so many years. They built a massive distribution and dealership network, and that was its competitive edge.
Right.
So I think that the opportunity is big, and in India, it's interesting in many consumer markets. If you see, across the consumer markets, the number one player has an outsized market share. And then the number two and the number three player are way below,
Right.
Yeah.
right? So whether it's liquor, then you have United Spirits, which has a 50% plus market
Right.
share. You go to beer, UB has
Breweries.
52, 51, 52%
Right.
market share, and the next guy is only 15 or 10 or 8, right? So when you have a lead which is so big, and especially India is a very complex country. The consumer in the north thinks differently from
Yeah.
the consumer in the
That's
south,
right, yes.
you know, west and east. It takes time for a new person to come in and establish itself. Obviously, the advent of e-commerce and the internet is going to make things difficult for incumbents because,
Right.
you know, today you are a third party seller, you can go on Amazon and sell your product. But not every product is going to be amenable to that. So I think we are at an interesting juncture in India where in some cases the strong will become stronger. In some cases the strong are going to be challenged because of the new models of distribution that are coming into play because of e-commerce. But there's still a lot of opportunity.
All right. And could you also leave us with 3 of your favorite books? It could be investment books, or it could just be books that you've just loved in general reading.
Yeah, I think you know the book that I read pretty early in my investment career was Peter Lynch's book,
Right.
and the other book which I liked was you know Edwin Lefebvre's book Common Stocks and Uncommon Profits, right? And then just on a very different take, I like to read books on Indian philosophy. You know, out there obviously Bhagavad Gita is at the top, but over time I've read several books on the Vedic philosophy, and I find it very interesting. It's amazing how such sophisticated thought was there with us 5,000-6,000 years ago.
Then, yes.
Back then. So yeah, I mean, this is.
Thank you so much, Hiren, for all the insights that you've given us. But before we let you go, what are your Diwali plans, if I can ask you?
Well, actually, I'm off to the US in Diwali, so my Diwali is going to be in New York. But I'm there on work. You know, so yeah, I mean, for me, it's going to be Diwali away from family and on work, you know, in the US.
Okay, fine. We wish you a very, very happy Diwali from the entire Bloomberg Quint
Same
team.
to you.
And yes, sir. And for all you guys, thank you so much for watching today's edition of Thank God It's Friday. We will see you on Sunday for the Diwali special Mahura trading session live at 6 p.m. from BSE. So we hope to see you then.